What's up team, it's Andy Wang from Clarico, and in this Structures Explained video, we'll be explaining the company structure. Now, there are a few different types of companies, but I'll be covering the most common one when it comes to small businesses, which is the private company or the Pty Ltd company. Like I said, most of the small businesses you encounter will be this type. I'll be breaking down this video into a few different sections. Firstly, we'll be covering what is a company. Then the benefits of a company, the disadvantages of a company structure, and then finally, who should consider using a company structure for their business or other financial affairs. Now, before we get into this video, disclaimer time. The information we cover in this video is just to help you understand the company structure better. We will be covering the main talking points of a company, and like there is with anything, there are nuances and exceptions to the things we talk about in this video, so we highly recommend chatting to an accountant before just going off and locking in the decision to structure your business as a company. With that out of the way, let's get into it. Let's start off with what is a company? In the eyes of the law, a company is a separate legal entity just like you and I. If you own something, it's yours. If I own something, it's mine. Your debts are your debts, my debts are my debts. They won't affect each other. When you go and start a company, you're pretty much bringing in a whole new, for lack of a better word, person into existence, and that person, company, can own things in its own right. It can have its own debts and most importantly, conduct its own business. Of course, a company isn't actually a living, breathing organism that can make decisions in its own right. So there are roles in a company that people can hold to make decisions on its behalf. There are two main roles in every company. Firstly, there's a directors, and secondly, there's a shareholders. Directors are responsible for the day-to-day running of the company, as well as making sure the company adheres to all of the different rules and regulations. Shareholders, on the other hand, are the actual owners of a company. The percentage of total shares they own normally represent how much of the company they actually own. I'll give you an example. Imagine if a shareholder owned 5 out of 10 shares in a company, then they would own 50% of that company. Being a shareholder also generally entitles you to two things. Firstly, the power to vote on major decisions of the company, and secondly, to receive dividends or profit distributions from it. That all being said then, what are the biggest benefits of the company structure? The first big benefit is limited liability. Remember what we said earlier, a company can have its own cash, debts, and conduct business in its own right. While there are exceptions, what this also means is that the company can get into legal trouble in its own right, and this doesn't have to spell trouble for the directors or the shareholders. The second benefit of a company is the capped tax rate. At the date of this video, a company will pay tax at a fixed rate between, say, 25% and 30%, depending on the size of the company. Meaning, no matter how much the company earns, it's only going to pay tax between 25 and 30%. Let's contrast that with a sole trader who will pay about 34.5%, including Medicare, on every dollar they earn over $45,000. That's a big difference. The final benefit is the flexibility in ownership. Remember, shareholders own shares in the company and those shares represent ownership, generally. What this means is that you can have a token of ownership to give someone for investing in your company or rewarding a superstar team member. The proportion of ownership can be like whatever you really want, and it's easy to change depending on the circumstances. It's just a few forms to fill out. Now, if you already own a company, I wouldn't go off and then start changing your share structure on the fly because there can be tax consequences involved. So please work with an accountant on any structural changes to your business. With the benefits out of the way though, let's move into the disadvantages. Unfortunately, it's not all just good news for a company. And before rushing off into starting a company, we do recommend considering the downsides. Disadvantage number 1, complexity. The complexity in a company comes in a few different layers. Firstly, remember the company is a separate legal entity in its own right, meaning the things it owns belongs to the company. This also means that you can't just treat company property like it's your own, and this includes the money in the bank account. Every time you draw money out of the bank account of a company and use it personally, it needs to be accounted for either as a wage, as a dividend, or a loan. Now, each of these have different tax consequences, and you'll need to work with an accountant to pick the right one for you. Another large layer of complexity is the legal obligations of a company. I mean, just to name a few, we've got a company needs to do its own tax return. There are special tax laws which are specific to a company and they need to be considered. Companies are governed by a regulation body called ASIC, and they have rules that they need you to follow. And at the time of recording this video, the government is looking into bringing in something called the Director Identification Number, meaning that's another thing that needs to be done when starting a company. Essentially, what I'm saying is that having a company means there's more admin stuff that you need to understand or be across. The second big disadvantage of a company is cost. When things become a bit more complicated, unfortunately, that means they need more work. And if something needs more work, unfortunately, it costs a bit more too. With a company, you have a few costs. You've got the initial setup cost. You've got the cost for ongoing registration to keep the company alive. This is paid to ASIC. And because of the extra tax laws and regulations, the accounting costs are going to be more for a company too. A lot of people like the sound of a company and they like the sound of being called a director, but these disadvantages do need to be considered before you sort of just take the plunge and decide a company is the right thing for you. So with that all being said, who is the company structure for then? You may want to consider the company structure if any of the below sounds like you. If you have grand visions for your business and you want to grow and scale your business, if you want to leave the door open to bring on potential investors or partners or reward superstar team members, if you're someone who wants to keep reinvesting in the business and don't mind leaving a bit of money in there, also due to the company's limited liability benefits, if you have lots of valuables personally, you might want to separate your business from you personally to protect your valuables. And if you don't mind having the extra admin burden or at least paying someone else to handle all of that for you, then it might be worth considering a company structure. Now, if all of that sounds a bit too much, then check out our other videos in the Structures Explained series to see what other structures may be worth considering. As always, if there's anything you'd like us to cover, please pop a comment in the description below. And if you found this video helpful, then we'd love it if you enthusiastically click that thumbs up button. And until next time, peace.